United, who's a sponsor for putting on this presentation. Just a couple things. So our other sponsors we'd like to thank today on our call. John Karakidis from BDO. Thank you, John. Michael Sabatini from Citron Cooperman. We also have Andrea Riga, who's a contributor from Variety Learning, and we have Ari from Ariel Vassell from Paylocity. Our other sponsors that are not involved today but have helped the chapter amazingly is Robert Half, Newmark Frank, Insperity, Nixon Peabody, and also our president's organization, BCP Consulting. At this point, I'd like to turn it over to Benjamin Horowitz, our president. He'll say a few words, and then I'll come back to me to start the program. Thank you.
Yeah, thank you, Drew. Appreciate the introduction, and thank you for introducing the sponsors on the call today. So yes, Benjamin Horowitz. I'm the president of the FEI chapter here on Long Island. Excited for today's presentation. Thank you very much to our sponsor that will be leading the presentation today. We do have a fireside chat coming up later in March, where we're going to have the CFO of Stop and Shop on our group, where she will be open to questions, talking about the journey of Stop and Shop over the past probably 12 months or so, and I believe her journey and her career to getting to where she is. So with that being said, thank you again to everyone who's on here. Thank you again to our sponsors, my fellow board members, other board members from other chapters in the tri-state area. I'll kick it back over to you, Drew. Thank you.
Thanks, Benji. A couple things about today's program. If you're looking to get CPE credit, there's one credit that'll be you'll be able to receive today. It'll be important that you answer the polling questions that are presented after each of the three speakers complete their brief discussion from BankUnited. Secondly, if there's any, because we have 34 people on the call, if there's any questions, please direct them to me in the chat, and I will see if we can address those questions. If we have time at the end, which we're trying to allocate some time, we'll have an open session. Everyone will be muted during the presentation until we have opened it up for any questions. All right. At this time, I'd like to introduce Christine Girula. Christine joined BankUnited 6 years ago and oversees a team of strong new bank relationship managers covering the Metro New York, Long Island, New York City, and New Jersey. The team manages a broad portfolio from industry's perspective, focusing on companies with revenues in excess of 50 million, which are in manufacturing, distribution, financial services, construction, online services, rehab, and country clubs. Sounds like every possible company. Prior to coming to BankUnited, Christine was at Santander Bank for 10 years, covering the Long Island market. Christine, in her free time when she's maybe doing Zoom calls, since she's been home for about a year, is involved in the American Heart Association, Ronald McDonald House, Long Island Breast Cancer Coalition, and St. John's Women in Business. Christine is a graduate of St. John's University. Christine, I'd like to turn the floor over to you to start the presentation by you and your colleagues. Thank you.
Good morning. Thank you, Drew. I appreciate that. And thank you for the opportunity today. So first, I'd like to introduce my colleague, Joe Roberto. Joe has been the president of New York banking operations at BankUnited since March of 2013 and is responsible for overseeing the bank center locations, commercial private banking, and deposit operations for the New York region. He was instrumental in all aspects of launching BankUnited in the New York market in 2013. Prior to BankUnited, Joe was senior vice president at Capital One Bank, responsible for the bank's commercial real estate deposit portfolio managing 7 teams in the Northeast, Mid-Atlantic, and South Central markets. Joe held leadership positions at North Fork Bank from 1998 up until the merger with Capital One. And he currently serves on the community board at Northwell Health South Shore University Hospital in Bayshore, the corporate advisory board of Cohen's Children's Medical Center, the corporate advisory board of Cold Spring Harbor Laboratory, and on the Dean's Advisory Board for the College of Management at Long Island University. Joe, thank you. The floor is yours. You're on mute, Joe. Joe, you're on mute.
Okay, sorry for the technical difficulty. Thank you, Christine, for that introduction. I appreciate it, and thank you everybody at FEI for having us here today. I think what I'm understanding that you want us to speak about, other than what we do, and I'll give you, that quick version of what Christine just described, is our view, currently of the economy. How that relates to, what we're doing here at BankUnited, but, the unprecedented times that we come through, and as we look through, 2021, what that in our eyes looks like in the local economy, U.S. economy. I know we have Rishi to speak, I think, more specifically about how we're looking at that more from an analytical perspective, but from day to day, touching our clients, what we do to acquire new business as we go through these times, and just, overall strategy. I'll give you my thoughts on how we see things shaping up as we come into 2021. Just quickly, as Christine said, my role here in managing the deposit operations is really the liability or deposit side of the balance sheet. We've grown that business over the 8 years that we launched the bank from 2013 to today to about a $6 billion contribution to the overall $35 billion asset size that we have at BankUnited all in. We operate, as I think many of you know, in the Florida market and New York market predominantly. We have some specialty businesses that have national exposure. But again, my responsibility in the New York market particularly is deposit development, working with 3 major lending lines of business, 2 who are represented here today, in Christine's line, in the C&I line. Mike, who runs a commercial book of business, which he'll speak about more specifically, and who is not represented here today, but a big part of our asset book in New York on the CRE side is run by a gentleman named Ben Stacks, who could not join us today. As we see it, the most interesting things I think we could talk about in terms of what we're forming our strategy around is where we see really the rate environment as probably the biggest kind of headwind, or at least where we see statistically a lot of conflicting information, even as recently as yesterday, as we see movement on the long end of the rate curve that Rishi will speak about, I think, in detail. It is certainly, made it very difficult on the compression of our net interest margin, all banks, as we kind of manage through a period where the flatness of the yield curve just makes it very, very challenging in terms of, the spread between liabilities and asset return. With that, we have all adapted to what we never really anticipated in terms of how we interact with our clients, as we're doing here today, virtually. Really an amazing, I think, technological lesson for all of us. And, many of us were concerned about whether we had the capability of being able to operate in a virtual setup. And we've done that and done that really well here. And I give a lot of credit to many of our competitors who have also managed to adapt to this type of, unplanned way of interacting with clients. From the standpoint of managing really the challenges of what I spoke about in terms of the economics, it really has come down to, what you're able to do within your own structure on the pricing end, which is very difficult from a competitive perspective, when yields on assets are where they are, and your cost of funds, which is really what my teams control in terms of the liability side of the balance sheet. And to that end, we continue looking, at least with a little bit of optimism over the last couple of days with the 10-year moving up, that there'll be some some spread that we'll be able to take advantage of. But I think the Fed's comments over the last couple of days that the short end will remain at a very, very low 0 to 25 Fed funds target, that we're going to have to continue to manage through some difficult times there. Happy to answer any questions specific about that. I think that is really, probably our biggest challenge. But with the teams that I have, 7 teams in particular in the New York market that are out developing business, and I know many of you on this call, we are, as anybody else, competitively poised to go out and continue to grow our book of business. There is an abundance of liquidity, which makes this even more interesting, whether it's from stimulus money or just conservative positions that many companies have taken in this unusual time. And with that, we'll continue to look to grow our book of business in the New York market.
All right. Thank you, Joe.
Yep.
Are there any questions for Joe at this time? Okay. Stephanie, can we, thank you, Joe. We'll revisit we'll have some time at the end also. Stephanie, can you put up the first polling question, please?
Absolutely.
Okay, everyone, please complete this question if you're looking to get CPE credits. Thank you. Okay, in a few minutes, Stephanie will give us the results of that polling question. Thank you. Christine, you want to introduce your next speaker?
Sure. Our next speaker is Michael Quigley, or Mike. He's the Executive Vice President of Commercial Banking, Managing Director, started the Commercial Banking Group for BankUnited in May of 2013. The group focuses on companies with revenues 50 million and less, and currently has over 600 million in outstanding loan balances and over 600 million in deposit balances with 10 lenders covering the tri-state area. Prior to BankUnited, Mike was with M&T for 15 years, where he started the business banking group in 1998 on Long Island and expanded it to include New York City. He grew that portfolio to 1 billion in outstanding loans with 15 lenders. Mike, the floor is yours.
Thank you very much. Thanks for having us today. We appreciate the opportunity. As Christine said, I did start this in 2013 when BankUnited came to New York. And I had known John Canis, John Bolson from a long time before that at Northfork Bank. I actually was at Northfork. And then, I was 15 years at M&T Bank, where we had great success. And it was a lot of fun building that. And I never thought I was going to leave there. But then the thought of being able to do it again, a new institution like this, like BankUnited, who I knew, the people in charge and whatnot, was just too good to pass up. Plus, I got to build the group. Everyone in the group I hired, right? So I have 10 lenders, as Christine said. We're in Manhattan, Brooklyn, and Long Island. And we're going to talk a little bit more about Long Island today. But I have those 3 groups, and we had great success building the loans and the deposits. We are self-funding. So what we do, we're not a transaction bank, right? We are a relationship bank. So anytime I go in to do a deal, it's not just to do a loan, right? And as Christine said, we focused on the revenues of 50 million and under, loan size from 1 million to 10 million. Those are targets, obviously. Could be less, can be a little more. Christine and I overlap a little bit, but we took this thing. We had 10 lenders. We started with 0 and grew it to 600 million in loans and deposit. The deposit side is important because we're a $35 billion bank. We're not Chase, where deposits just flow in naturally. So we work with Joe's team very closely. We're a partnership, and we really come into the customer with everything. Joe's group is fantastic. They come in on the deposit side, and we come in on the loan side. And we're full service. We bring the bank to the companies because we don't have a ton of brick and mortar here. And it's worked obviously very successfully. The one thing that my group does kind of specialize because of the size deals that we do is the SBA 504 program. And that's a great program for businesses, for those who don't know, because the hardest part of buying a building is the down payment. Usually it's 25%. That program, you only put 10% down. And that pretty much covers all of our owner occupied mortgages. When I say owner occupied, greater than 50% occupying the building is the operating company, right? And that's a really great program. We do a lot of them on the board there, Pursue, formerly NYBDC. So I really have ins and outs of that program, and I've done a lot of deals. My team has done a lot of deals, and it's a really great program for anyone that's interested in buying a building. Which, by the way, Long Island, it happens more Long Island than Brooklyn and Manhattan. So it's kind of why I talked about it a little bit. Business owners here like to own their industrial buildings. It's just something that happens throughout my career. It's what we lead with, and it's why my group didn't get hurt too much during COVID. They're sticky deals. They don't go bad. And we did actually grow my group this year, which is amazing in a COVID year. We did grow both in loans and deposits. So I think says something about the bank and the people involved. The one thing I would talk about is, obviously we've been through something no one's been through before this pandemic. But like I said, we still grew, which says BankUnited is still lending. What's different right now, and the CPA can probably attest to that, is we have to get a lot more financial information, because we need to know. The basic thing is we always look back historically on how companies do. Now we're looking kind of forward and current time, right? Versus for a banker, it's always about the fiscal statement. Well, that's old information. Now we went through COVID. We're asking for more information because we have to. But when we get that information, if we can prove, hey, they came out of COVID okay, we're doing those deals. And like I said, I booked over 130 million in new deals last year, and grew the outstandings as well. So, and we really didn't, knock wood, have any deals go bad. Again, very good portfolio. I think it speaks a lot about the bank and what we can do. And, Christine's group does, she does the bigger deals, and she'll talk about that later. But our group, we're dealing with business owners, generally, not so much CFOs, sometimes on the higher end of 50 million, but we're in there with the owners, and it's really a very custom approach to it. And sometimes it's challenging, because when you have a smaller company, say 10 million, 15 million in outstanding, and revenues, they don't have the CFO, the controller, and we're trying to get some internal information from them so that we can do these deals during this pandemic. But obviously, I think we've come through it really well. I think 2021 is pent up demand. We even have some programs in place. I could talk to people offline about what we're doing on the owner occupied side. We have some nice rates, some nice structure that we put together, trying to jumpstart the loan process for 2021. So BankUnited is fully in. We want to do loans, we want to do deposits, but we obviously will have to be do our due diligence and make sure we get all the right financial information, which we're keeping the CPAs busy, so I'm sure they don't mind. And that's my story.
So Mike, I have a question for you. With regard to the bank's appetite for new loan transactions, how is the bank looking towards whether you're doing asset-based lending or credit lines or term loans?
Yeah, so we do everything, right? We do, I mentioned the owner occupied, but obviously, we do lots of lines of credit, term loans for equipment. And depending on the size, Andrew, of the request, Christina will always do a lot more formula based, because they do larger lines, but we'll either do, if it's larger, some formula based lines, or we do smaller lines that require like a 30-day cleanup. But those are the asset based deals, and we do them every day. Because anytime I do an owner occupied mortgage, which I was just kind of talking about, we always do a line as well, because 90% of businesses have lines of credit. The reason we sometimes lead with the mortgage is because it's an action item. They need to get the financing. A lot of times when you're trying to get a company to switch from bank to bank, they don't really have to, and it's a long process. If they're buying a building, they have to do something. So we lead with that, but we do everything. Again, deposits, lines of credit, if they need equipment, term loans.
Okay, good. Christine, do you want to add another question maybe to Michael at this point, based on what he said?
Another question?
Anything else you want Michael to cover at this
Oh,
point?
no, Mike and I sort of complement each other. So when I get to the corporate banking, I'll discuss that more.
Okay, great. Just the results of the polling question. The question was, do you think we'll be better or worse than last year? So 55% of the people said 2021 will be better than 2020. 28% said 21 will be just like 20. And we have some people that are 17% of the team group out there think it may be worse. So let's hope the 17% people are wrong, and 21 is a bright year for everyone. Okay, great. Okay, well, again, we'll take up questions at the end because some of the questions coming in, we'll see which person from BankUnited maybe has covered the topic, and if not, we'll talk about it at the end. Christine, back to you.
Was Stephanie going to put up a second question at this point?
Yes,
Yes.
I'm going to launch the second poll question for everyone now.
Right on, Christine.
Okay.
Christine,
ready?
you're up now.
Okay, yes. So as Drew mentioned, I am the team leader for New York corporate banking covering Long Island and metropolitan New York. Our focus is on public and private companies with revenues of $50 million and up. So we pick up, we complement Mike Quigley's team. Our companies generally have credit needs of 10 to about $40 million, with that sweet spot in the 20 to $30 million range. And we provide working capital, short-term lines of credit, revolving credits, and term loans for longer-term financing, as well as owner-occupied mortgages. And we also do ABL light type of transactions with monthly borrowing bases. The New York corporate portfolio has about $2 billion in commitments and $1.7 billion of deposits. And there are about 7 lenders that cover that New York marketplace with those $2 billion of credit commitments. And we are generalists. We cover just about every industry, as you mentioned: manufacturing, distribution, service, e-commerce. We have debt relief, video conferencing, transportation. We really cover the gamut. We also have some industry verticals at the bank, which are healthcare, not-for-profit, ESOPs, and financial services. And we partner with these verticals in the bank, so we can really cover everything. The typical credit transactions would be one-off, where we're the only bank, club deals where there may be 2 or 3 banks in the transaction that we share with, and shared national credits, or SNCs, that start at $100 million of minimum credit and are typically shared with 5 banks or more. 2020 was really a challenging year, and we probably spent most of 2020 providing principal and interest deferrals, waivers and amendments to loan agreements, and of course, PPP loans. And BankUnited funded over 3,500 PPP loans, aggregating $830 million. There was really little new activity in 2020. Most companies didn't want to make any kind of changes in their banking arrangements or expand operations because they just really didn't know where this was headed. But there were essential businesses that did really well last year that we had in our portfolio, which included food distribution, online delivery services, paper manufacturing, and government contractors. And other companies actually pivoted their businesses to produce PPE equipment and products. And although these essential businesses did do well, they too experienced, had some COVID challenges, because even though management provided all the necessary distancing amongst employees and took all the necessary precautions, they found that people are still people and they still want to socialize together, and they would eat lunch together in their car or go out or socialize after work. And many of these companies found that they ended up with a 20% COVID infection rate. And that really affected their production capabilities for a period of time. In 2021, so far, we've seen some new business activity. There have been requests for refinancings, some equipment financing, even some acquisitions. So it seems as though with the availability of the vaccine and the combination of interest rates still at record low levels, we see there is that there is activity, and the trend seems to be positive for this year. So I'm hoping that that small group of people who think the economy is going to be worse are going to be wrong this year. We're seeing an upward trend.
Christine, how is the time to close on transactions? What it was in 20 and what you foresee it to be in 2021?
It's probably taking a little bit longer because people are doing more due diligence. Actually, one of the things that's now required, and I understand this is amongst all the banks, is everyone has to include as part of their due diligence how COVID affected the business and the industry and how it will affect. It's a new credit risk that's added to every credit write-up now. And it's not just us, it's all the banks throughout the industry. So there is definitely more due diligence being done.
And for the CPAs in the room and the various firms, do you expect that the requirements, if a client required a review, that there be any changes in the level of financial statements that are being provided?
Not really. Our policy is generally if a loan is more than $5 million, we generally look for an audit. There is some leeway in that depending upon the assets, collateral, whether field exams are done, but less than 5 million and under, and Mike, you tell me if I'm incorrect here, but generally review statements are okay, but over 5 million, we generally look for an audited financial statement.
Yeah, the only thing I'd add to that, Christine, is there's some relief if it's, real estate heavy. So in other words, like if I do a $2 million line and, $5 million mortgage, I can still do a review. But if the line was 5 or more, like Christine says, then it's an audit. So it depends on the mix, but yes, that's the breakdown.
Okay. Are there any other questions at this point? So there's one question, and Christine, if you think we should wait till where she finishes, we'll hold it off. But the question was, with the additional 3 million in 30 trillion in debt, and the risk, what is the risk to the economic growth going forward as we come out of the pandemic? How do you see monetary and fiscal policies adapting to this issue? And then someone added, what are the challenges around commercial landlords given empty office space and the hard-hit hospitality industry? If you want to hold that question off till later, or one of your colleagues wants to jump in now, we can do that.
I think Rishi could probably, after he speaks, he could talk to the this 30 trillion in debt. And I see there's another comment here about covenant changes, et cetera, loans at the corporate level. We have been, I think, very, very flexible on covenant changes. Most covenants are measured on a trailing 12-month basis. I did do one transaction where we actually changed the covenants for a short period of time, not to be a trailing 12-month because of what happened in Q2 and Q3. So we actually measured them on a quarterly basis, and we're going back to a trailing 12-month in 2021. So the bank has been very flexible, I think, in bending and looking at things differently and not saying, well, just because this is the way it's always been done, this is the way we have to do it. So I think we've worked with our customers quite well through this period. And we do have, especially in the corporate portfolio, we do have a hospitality portion of our credits, but many of them are very large type of restaurant groups with people who had deep pockets. So they're okay. I mean, they'll survive. They've had a tough time, but we've worked with them through this pandemic as well.
Yeah, I think I could add one more thing to that is that, the one thing we did differently is, especially in the beginning, we spoke to our customers weekly. We were in constant communication with them to find out what was going on. We reported, and I think that helped the bank to be flexible, as Christine said, because we knew what was going on. So then when we had some calls, I had a weekly standing call about, different industries, right? We rated them A, B, C, and how frequent you talked about them with credit. And this happened for a long, it's still going on now. It's only once a month, but it used to be weekly. So then when we went to talk about things, it wasn't a surprise because I was reporting weekly on this stuff, right? So they didn't knee jerk and go crazy with covenant changes and whatnot on the negative side. And the senior credit people were all involved in this, and they would step up. Oh yeah, Mike talked about this for this company. They're good, that kind of stuff. So the communication was the key to not overreacting with covenant changes that would hurt the customer. And like Christine said, we were flexible when it made sense.
And we did quite a good number of principal and interest deferrals in March and April for the first 90 days, which really helped people out. And then some needed a second P&I deferral. So, we did between 90 and 180 days of principal and interest deferrals.
Well, that's great. Thank you. Just to go over our second polling question. The question was, do you expect to borrow more or less or the same in 2021? And great news for BankUnited. 50% of the people said they expect to borrow more. 4% less. People said no change, 32%. Okay, so they're not paying off any of those financings. And 14% people, they would be looking for other type debt arrangements. Okay, great. All right, why don't we move on to our, we have another polling question, right?
Yes, I'm going to go to our third polling question for everyone now.
Thank you. Okay, Christine, why don't we move on? And, I suspect that the third polling question, when we talk about the results, there may be some questions from the group relating to the PPP program, previous program, and current. Well, maybe we'll just jump on this now. So the question was, if you applied for PPP, how was your experience? And 54% of the people said positive, 4% negative, and 42% said not applicable. I think Mike referred to the PPP program, or you did, Christine. Maybe you can just give us a few words on how you're addressing the current program and how you might be able to help some non-banking relationships with the current program.
Well, just so that everyone can appreciate, the PPP program was kind of thrown at the banks, and the banks were unprepared because we didn't have a staff of people just kind of sitting around waiting to do PPP loans. So we had to pull people from every single department in the bank and give them a crash course training class on how to process these things. So the bank really did a great job in doing that. And we were able to provide, again, I mentioned 3,500 PPP loans for a total of $830 million. And that all happened in a matter of weeks. So I would say overwhelmingly our customers were really happy with how we handled that and how attentive we were to that and how quickly we came up to speed. The round two here, my understanding is there's been lots of changes and it's been a constant, things have been moving. So the PPP portal and our round two is coming up, or the forgiveness is coming up along with round two. And we're working on that now. And again, we're doing the same thing. People are being pulled from every department in the bank, and we're doing a real personal touch where there is a person that you can talk to and make an appointment with and schedule to go over your how, whether you qualify for how much and so forth. So round two is coming up fast and furiously, along with the forgiveness. And the other thing that we've had some questions and some discussions with customers is, if you had if you got the PPP loan in 2020 and it's forgiven in 2021, or it has not yet been forgiven, how do you treat that on your financial statements? And that could be a whole nother question we can have with some accountants here, because my understanding is there's no hard and fast rule that if you feel that it's probable that your loan will be forgiven because you have all of the backup material and you feel that you've fulfilled all of the requirements, that you can assume that that loan was forgiven in 2020 for financial statement purposes. Now, I don't know, I've heard two different sides of the story, but most of what I've read is that you can assume forgiveness and that it happened, even if it doesn't actually happen until 2021.
I've seen that
But,
on financials already. Yeah. I've
You
seen
have,
that.
yeah.
Yeah.
Yeah, I've seen it both
Well,
ways. We
yeah.
have one who is taking it, who is assuming that it's being forgiven in 2020. And we have others who are saying, no, it's still considered debt at their 12/31/20 year end. And it's not forgiven until it's actually forgiven. So,
And Andrew, I'd like to add one other thing just for the group to know. With the second round of PPP, the participants, because there's a lot more rules on it, there's restrictions, you had to be down 25% in revenue 1 quarter or for the year, depends. And there's caps on it. From our perspective, we did, like Christine said, we did 3,500 loans in the first round. We have about 1,100 right now, and it's really slow at this point. So in other words, we don't think we're going to do much more. And right now there's a blackout period for the small companies of 20 employees and under that Biden had, signed. So right now there's nothing being done except for the real small ones. And even right before that happened, it's just about over as far as people making appointments to apply for more PPP loans, right, Joe?
Yes, to that point, I think statistically, most banks are reporting about a 30% demand on the second draw. And I think in terms of the overall pool of the 284 billion, there's probably 150 billion that's been put out or at least committed. So the kind of hysteria of round one is not here in round two. And I think you'll see things taper off on second rounds or second draws of first round borrowers. The forgiveness piece, to Christine's point, there's been a lot of changes and a little bit of ambiguity as to what forms need to be used and how. So that has been delayed and will start up at least on our portal this week with the window that ends at the end of the month. So you'll see a lot of forgiveness apps that'll come through. We've probably done about 1,000 forgiveness applications already out of the 3,000 loans that we did. So that will be, the next 30 days, a good amount of our time spent on that. But the borrowing side of round two draws or second draws of round one borrowers, I think is pretty much coming to an end at this point.
So, I can tell from a personal experience, the decline in the qualifications for the second PPP loan are quite significant. I mean, for a company to have been reduced revenues of 20%, my client that I worked on didn't qualify happily they didn't have a reduction of 20%, but they could use the assistance, but they don't meet that criteria in the second round of PPP loans.
Andrew, I see a question. Should we answer it on the chat?
Sure.
So someone said that they have a client looking for an SBA loan, and how long will it take with PPP being the priority? It's really not going to affect it, because like when you deal with the company, you deal with the bank, and then the company pursued is the local one that handles the SBA 504s. They have pre-approval. They don't really need to get the SBA's approval unless it's something outside the box. So it shouldn't slow down the SBA 504 request because they're preferred lender and they can approve it in-house as long as they follow all the SBA guidelines. So it should not slow it up.
Okay, there's a few other questions, Christine, on the PPP. Maybe you want to address those?
Yeah, the one they're looking at a customer's forgiveness documentation. We're not really looking at the documentation. It's really up to the customer, between the customer and their accountant to make that decision.
So, John Karakitis and Mike Sabatini are on the call. I don't want to put you on the spot, but if either of you want to address the how you're seeing the accounting for the forgiveness before the actual forgiveness occurs, either of you could jump in.
Sure, I'll jump in, everybody. I think the way it was,
That's Mike Sabatini, everyone.
yep, oh, Mike Sabatini. I think the way it was described is accurate. There really is no hard and fast rule. You can analogize it to what we would call the debt model in GAAP and keep it as debt until you have full forgiveness from both the bank and the SBA side. Certainly the more conservative approach to do that. There's also this analogous approach to something that's not in US GAAP, but it's in the international standards about accounting for, almost government type grants. And that's the model I think that was talked about, where if you use the money for the proper, usage and you're, have the documentation to support it, and effectively you think all or some or all of the loan will be forgiven, you can, go with that approach. Certainly need to talk to your, accountants about it and auditors and make sure you have proper documentation. And I have seen personally clients, again, doing it both ways. I mean, my conservative accountant's view would be leave it as debt until but hey, if you've really spent the money on the purposes and it's pretty obvious it's going to get forgiven in whole or in part, I mean, that seems to be okay. There is a question, though, about where you reflect that forgiveness in the financial statements. Some think you offset the expenses, and some think it's better showing it, below the line in other income. We take the view that below the line is better because the truth is you really did have the expenses and you're just, had them funded from, government assistance effectively and for comparability purposes. But there is that view that you could net it against the applicable expenses as well. So just throwing that out there.
I was doing an amendment of I was doing an amendment of a financial loan agreement in August, I think it was, or maybe July. So what we did with they got a PPP loan, and what we did was for financial covenant calculation purposes, we said we would exclude the amount of the PPP. So whether it was a loan or whether it was income, we would not include it in EBITDA or in their debt. So it would just take it out of the picture, so it wouldn't throw the covenants off one way or the other. But I'd love to continue talking. I just want to give Rishi the opportunity. I'm sure you want to hear Rishi speak. He's really terrific. So I'd like to introduce Rishi at this time. Rishi Bansal has been the bank's chief investment officer since February of 2017, and most recently served as executive vice president of the mortgage portfolio. He joined the bank in July of 2009 and was part of the advisory group that worked on the bank's acquisition. In his role as chief investment officer, Rishi is responsible for the bank's investment securities portfolio and manages the bank's residential loan portfolio, residential mortgage warehouse business, and Pinnacle public finance business. Prior to BankUnited, he was a managing director with Merrill Lynch and at Lehman Brothers. So Rishi, please take, everyone's I'm sure is waiting to hear what you have to say.
Hi, everybody. I had a quick question. Should I share a screen? I've got some material that I could share, but I tried, I can't share it right now. If somebody can make me co-host.
Sure. Hold
Stephanie,
on
can
one
you do
moment.
that?
Yes, I can.
Okay. So I'm going to start off with what has happened from a COVID perspective, because that is typically what people most focused on. We all know One second, what's going on here? Is somebody else controlling the mouse? I think somebody else is moving their mouse. There we go. So this is a chart which kind of gives a picture of what has happened to COVID. So the blue line is the cases line. We can see, from our own experience in the Northeast, cases spiked in April, May, then we had a second wave in July, August, and then we had the real big one in fall, November, December, Jan, there was Thanksgiving, there was Christmas, and with a lag, you can see the cases kind of follow that line. And what we have seen is since early January, we have had a very persistent decline in cases. It is not all due to vaccines, but the vaccines have played a role. The red line is the real bad one, which is deaths, right? And we can see that deaths really peaked out in April, May. So most people believe that case counts were significantly undercounted in April, May. But deaths could have been much more than cases, partly because doctors really didn't know how to handle it. But there's a lot of fear, there's a lot of experimentation, necessary experimentation around what was going to happen, right? People didn't know who was going to live, how to prioritize, whether ventilator is the right thing. People didn't know how much masks there should be. So there was just a lot of uncertainty back then. And the yellow line is vaccines. Now, all these lines are to different scales. So vaccines, we are averaging now at roughly 1.2, 1.3 million vaccines a day. That's a very good number, right? I have this other chart which kind of helps show what has happened to cases and vaccines over time. So this line, the blue line essentially is the cumulative case count in the United States. The white line is the number of cumulative vaccine doses in the United States. And number of people who have essentially gotten immunity through vaccines or partial immunity through vaccines now far exceeds the number of people who have sadly gotten their immunity the old-fashioned way of getting infected. So that is the big message I want to leave you with, which is 2021 will be better than 2020. And this chart is why it will be better, right? Now, there was a lot of things which happened in 2020, which made 2020 not as bad as it could have been. The big one was we had a Fed and Treasury, which were experienced with the last crisis. So they didn't take too long to react. They reacted far earlier than a lot of other systems did. The Fed cut rates, in an election year, we had Congress able to still pass stimulus. As much as we kind of talk about dysfunction in DC, that part of it, the stimulus part of it worked, right? And it really, really helped the economy. So I'm going to just talk at a very high level about the economy. It's forecast. Give me a second. Okay, here we go. So what happened at a very high level in the economy? We had, from a quarter-on-quarter perspective, amazingly bad Q2, right? GDP went down 31%. Not anything anybody has ever seen, right? Consumer spending was down 33%. Investments were down 46%. Exports were down 64%. Imports were down 54%. These are like staggeringly bad numbers, right? And they are actually far worse than what happened in the great financial crisis of 2008, 2009, right? And we basically, but even though we saw the virus charts, Q3 was pretty bad virus-wise, right? Not necessarily in terms of deaths, but the number of cases, and it became widespread. However, what happened to GDP? Partly as a result of stimulus, partly as a result of Fed action, and partly as a result of people figuring out that not everybody was going to die, GDP came back strongly. People made significant investments in being able to work from home. People made significant investments in Zoom. All of us people, and I've been around for a while. I never thought I'd be doing meetings over video all this time and get used to it and get millions and billions of dollars of business done via Zoom. But it is different, right? We are all traveling a lot less, right? I haven't been in office for any continuous period of time since March of last year. I haven't been near an airport. I haven't gone to a hotel. Right? I've eaten out a few times, right? But large parts of the service economy changed. But the Q3 growth is impressive, right? Q4 was more normal, and Q4 grew 4% quarter on quarter. When you look at the overall year, 2021, economists forecast is at almost 5%, 4.9%. That is one of the strongest GDP numbers in a long time. What that means is, with 2020 being down 3.5% in GDP, we are actually going to end 2020 with more activity than 2019. So that's a big positive message. The system is very, very flush with liquidity. Joe and other people on the deposit side can probably talk about this, and I'm sure you guys are all experiencing this. Every bank is flush with liquidity. Every customer is flush with liquidity, right? A lot of that has to do with Fed action. A lot of that has to do with stimulus, right? The amount of income replacement that happened as a result of the CARES Act was more than 100%. There's a lot of people whose net income went up in 2020. We don't necessarily feel it in the Northeast because of the higher cost of living environment, but there are parts of the South, the parts of the Midwest, the parts of the Southwest, where the amount of money that was given through enhanced unemployment benefits, through the CARES Act, through all the fiscal stimulus packages, actually led to people having more savings, which has shown up as deposits. I want to talk a little bit about rates and inflation, because I think there was a question around the debt. So I'm not a modern monetary theory guy. They believe that as long as you can print money, but there's no inflation, you don't have to worry about future inflation. And if you just look at the last 20 years or 30 years, it does look like that's the case, right? What we have to remember in a very long-term period, right, that post-World War II, there was a very long period of low inflation and reasonably stable interest rates. And there was an exogenous shock, the oil shock, in the late 70s and early 70s. There were two shocks, which essentially got people to start thinking about inflation as a persistent phenomenon. And once essentially the inflation expectation got anchored at a high level, the Fed had to essentially dramatically shrink the economy to get those inflation expectations back down. But inflation then was a global phenomenon. In inflation today, the global phenomena, right? We have people who are competing to export, right? China and Japan and other countries, which are trying to export a variety of things. if one country doesn't export, then another country will. So there's a overall deflationary trend which is there, and the central banks have been fighting it. I think a lot of people have thought of Japan as a exception, and Japan has had a population decline. But so there's two very, very different things going on. There is a lot less population growth today than there used to be, and that is partly driving inflation lower. And secondly, a lot more stuff is being produced in places where costs are lower, right? Long Island in particular used to be a very big manufacturing hub, right? We used to make the fighter jets here, we used to make MRI machines here, we used to make all sorts of things here. But we became expensive, and stuff moved from Long Island to other parts of the US which are cheaper, and it moved to other parts of the world which were cheaper. And that dynamic has not fully played out yet, right? So this general long decline in population growth, and we can spend hours talking about dynamics of population growth, but education has played a role. Women empowerment has played a role. Positive things have led to reduction in population decline. It's not like people have suddenly lost their ability to grow. And that fact, combined with the fact that we have the globalization phenomena, has kept inflation low. Will it eventually, will enough stimulus eventually break through? It can, right? Countries which run persistent external deficits can suddenly find themselves in a very different spot, right? A lot of us have heritage in either South America or other countries which have had persistent high inflation. And persistent high inflation and high external debt and money printing are all intricately linked. But the Fed, the markets have essentially been over-predicting inflation now for a long, long period of time. And I think they're gun shy. So Fed essentially changed its framework to say, we will only start raising rates when we see actual inflation. That's a huge, huge deal. But the market is not fully believing it. That is why the curve has steepened quite dramatically since the beginning of the year, right? The 10-year, as when I left my screens in the morning, was at 145, right? In August of last year, we were at 51 basis points. We're up almost 100 basis points. On the other hand, the 2-year is still below 15 basis points. So the curve has steepened. There is a lot of comfort that the Fed will not raise rates this year. There's a lot of comfort they will not raise rates in the first half of next year. What happens after that is there is guidance that they probably won't raise in 2020, but there's no guarantees. And so that's the basic interest rate dynamic that people are dealing with, right? So you could essentially lock it in by using derivatives. You could basically try to take out fixed rate loans, or you could essentially just roll the dice. So there's all those type of things that you could do. Right now, there's also a SOFR transition coming up, which I'm sure all your bankers have talked to you about. That's going to be messy. They're trying to make it less messy. Everybody's working hard to make it less messy, but I'm sure the CPAs are worried about it. I'm sure the bankers are worried about it. I don't think too many owners are worried about it because, at the end of the day, it's a few basis points, but, anybody who has a lot of leverage has to think about it hard.
Rashi, can I interrupt a second?
Absolutely.
We're okay on going over, but we do need to do the last polling question. And if people want to stay on a few minutes, we can do that. So Stephanie, can you bring up the last polling question? And we'll go over a few minutes if we need to. Okay, everyone, please answer this question.
Drew, I do have to
I have
jump,
a
but
quick
thank you,
question.
thank you to
I have a
everybody.
quick question. If we need to jump off at 9:30 for other meetings at work, do we still get full credit for the CPEs?
Answering the 4 questions, you'll get your full CPE.
Thank you very much. And thank you to BankUnited for this.
I know that our president had to jump off, but we're willing to stay on another 5 minutes for let Rashi complete and leave a couple minutes for any questions. So Rashi, it's pretty interesting. How can you react to this polling question? Increase in rates 28%, remain unchanged 52%, decline 4%, depend upon President Biden's tax policy. Maybe you want to address that before people jump off.
Sure. I would broadly say that it depends on the part of the curve.
It depends what? I'm sorry.
For the rest of this year. Depends on the part of the curve. Are you looking at the short rates, like rates for the for like 1 month rates or like money market rates?
I would say rates over the next 12 months. Rates over the next 12 months.
Yeah, but I'm just saying that rates over the next 12 months on the short end of the curve, right?
Yeah, I think they're talking about the Fed rate. They're talking about the Fed rate.
Oh, the Fed is not going to change rates in the next 12 months. Now, what they do.
I think Rishi's cutting out. His
Yes, they're going to go up. Sorry about that.
Rishi, your mic is cutting out. We don't hear you.
Yeah. Can you hear me now?
Yes.
Yes.
Okay. I think the
So
screen sharing was ending up with some bandwidth issues. Sorry about that.
Okay, so we have a few more minutes if you want to address our last question on the Fed funds
Yeah,
rate.
so I think short-term rates will remain stable for the next 12 months, at least for the remaining of 2021. I do think long-term rates will continue to creep up through the course of the year. What has happened over the last few weeks clearly has not been creeping up, it's been galloping up, but I think short-term rates will remain stable, the long-term rates will go up.
Great, thank you. For the people that are still on the call, I'd really like to thank the representatives from BankUnited. This was a great presentation. Please take advantage of reaching out to Christine, Mike, Joe, and on relating to any banking questions. They'd love to help out. And again, thank you for attending, and we look forward to you attending our future FEI presentations. Christine, any closing comments from you on behalf of the bank?
No, we thank everyone for their time today. And I understand that you will send around contact information. I'll put my email address in the chat box here. If anyone wants to reach out to me, I can certainly put them in touch with either Mike or Rishi or Joe, and we'll be happy to discuss any topics that you want to talk about. And thank you for giving us this time today. It was really great.
Yeah, thank you very much.
Yes, thank you, everybody.
Okay, great.
Thanks.
Thank you. Thank you.
Great stuff, guys. Thanks a lot.
Bye-bye.
Bye.